So what is the difference between a foreclosure and a short sale? Well, a foreclosure is when the bank forecloses on your property because you did not make your mortgage payments. Now, there are other terms, remember, in that deed of trust or mortgage that we discussed. And if you violate any of those terms, the lender could also foreclose. So for example, if you don't make your taxes, don't pay your taxes or quit paying homeowners insurance, the bank will normally pay those taxes for you or put an insurance policy on the property for you. But if you don't correct that situation, they could foreclose because you're violating part of the terms of your agreement with the bank. So that's a foreclosure. Foreclosure would take place at the courthouse. The sheriff normally does that. If you owe $100,000 on your bank balance and you owe another $5,000 in back interest and payments, and you owe another $2,000 in back taxes or insurance you haven't paid, and the court sale is going to cost $1,000, that's $108,000. So the sheriff on the courthouse steps on the day of foreclosure will say, I open the bid, I'm going to open the bidding, and the trustee from the bank or someone from the bank will be there and say, I bid $108,001. Now, why do they bid that? Because that takes care of back interest, that takes care of the taxes and insurance you owe, that takes care of the cost of the sale, and it takes care of paying off your loan. If there's no other bidders at the courthouse sale, then the bank gets the property back and they will then resell the property or try to resell it. And that's when they may have you do that BPO, remember, the broker's price opinion. Now, let's say someone's at the courthouse and they're like, well, I'll bid $110,000. Well, the bank will zip their mouth and not say anything else because they're going to get their money and they're happy. And so if no other bidders bid on that date, then the bidder for $110,000 gets the property. Well, the bank will only get $108,000, so there's $2,000 left over, and those would go to the junior liens. Remember, we call those junior liens, and that's why the date and time of recording is so important, because whoever was recorded next in line will get paid, and then the person after them, and so forth. Now, let's just say there were no other liens on the property. Who gets that $10,000? Well, the defaulting borrower does. They would get the $10,000 in that scenario. So what about a short sale? Well, a short sale is when a borrower is about to lose their home or they're in financial trouble or difficulty and their home is not worth the current market value that buyers are willing to pay. Recently, I had a property that was only worth around $80,000. However, the borrower owed over $100,000. So I was able to work with the bank to do a short sale. And the bank was willing to accept a lower amount and allow the borrower to go on and sell the property and avoid a foreclosure. So a short sale just enables the defaulting borrower, the person who's in trouble and whose property value has dropped, however their loan balance is above what their property is worth. So we call that a short sale, and a lot of lenders will do that versus going to a foreclosure. Now, one thing you need to know about short sales, there could be some tax implications for the defaulting borrower or the borrower who's selling the property on a short sale. So just remember that you need to seek legal counsel in this situation. Now, I use the term defaulting borrower. It's a seller, but they are the original borrower on that note. So don't get that confused. I just want to make sure you understand that the seller, who's the borrower of that original note, has a higher balance on their property than what the property is actually worth. So the bank will allow what is called a short sale to allow them to go on and sell the property. But there could be some legal consequences. Always check with your CPA and your attorney before making any decision like that.